Google Search is facing inevitable traffic declines amid AI competition and changing user habits. Large tech sector staff reductions continue. Windows 11 deadline is approaching, and it couldn't come at a worse time. Welcome to Hashtag Trending. I'm your host, Jim Love. Let's get into it. Google's recent antitrust trial has revealed some interesting discussions at Google, including the fact that Google executives may be acknowledging that a decline in traditional search traffic is inevitable, driven by the rise of AI-powered tools and resultant shifting user behaviors. More recent data shows they should be concerned. A Bain study from February revealed that 80% of consumers now rely on AI-written results for at least 40% of their searches, reducing organic web traffic by as much as 15 to 25%. Further, those using AI to search were far less likely to click through to a site, with up to 60% not clicking through. That could indeed spell a massive loss of revenue for Google's per-click model of revenue generation. So the documents show that Google execs are worried about losing search traffic to AI chatbots like ChatGPT, as well as to Google's own AI assistant, Gemini. The introduction of AI-generated summaries, known as AI overviews, to Google searches also led to a decrease in users clicking through to websites. These AI overviews were very popular, but they were decreasing Google's revenue. Google executives were emphasizing the urgency of monetizing Gemini to counteract this trend. Failing to fully get behind AI search could effectively cede the ground to ChatGPT, Perplexity, and perhaps others. And this new development followed on an already shifting digital landscape. A report by Enders Analysis indicated that traditional websites are experiencing reduced traffic not just due to AI technologies, but also to social media platforms. The antitrust suit against Google Chrome also revealed that Apple is exploring alternatives to Google as the default search engine on Safari. Apple executive Eddie Q testified that the company is considering AI-powered search options which could significantly impact Google's search traffic. So while these issues present enormous challenges for Google, they also affect marketers and publishers and will force a reevaluation of strategies in a range of companies. Optimizing content for AI platforms may become as important as search engine optimization, maybe more so. In the short run, in terms of digital marketing, diversifying traffic sources may become increasingly important. In the long run, we may need to develop an entirely new approach to online advertising. But given the structure that currently supports the pay-per-click and SEO-driven models, this could represent a huge upheaval in the industry as the model that disrupted advertising in print finds itself disrupted. 2023 and 2024 brought a serious round of reductions in staffing at major tech companies. And that was largely blamed on overly aggressive hiring during COVID and seen as a necessary readjustment. But the decline in staffing in big tech companies continues, and at least part of that may indeed be the first solid wave of AI-related downsizing. This month, both Microsoft and CrowdStrike announced significant workforce reductions, attributing the cuts to strategic shifts towards artificial intelligence and operational efficiency. Microsoft disclosed plans to lay off approximately 3% of its global workforce, equating to around 6,000 to 7,000 employees. The company said that this is part of a broader initiative to streamline operations by reducing management layers and increasing the ratio of engineers to managers. The explanation is that the company aims to enhance agility and efficiency as they invest heavily in AI technologies, and they have plans to allocate about $80 billion in the 2025 fiscal year towards AI development and hosting. CrowdStrike also announced that it would cut about 5% of its workforce. The company cited the need to improve operational efficiency and plans to leverage AI to streamline its business processes. Now, these companies aren't suffering in terms of revenue or profitability. CrowdStrike reported a 25% year-over-year revenue increase in the fourth quarter. Likewise, Microsoft announced better than expected earnings with $25.8 billion earned in the last quarter and a bright outlook for the next quarter. And it's not like they don't have problems to solve in their organizations that they could be using that extra staffing to do. Microsoft has had a number of failures, and CrowdStrike has had its own problems. So these layoffs reflect a broader trend in the tech industry, where companies are restructuring to adapt to the evolving AI landscape. The emphasis is on flattening organizational structures, reallocating resources to areas with the highest impact, particularly AI development and implementation. But companies are looking to all aspects of their organizations, from HR to operations and everything in between, to reclaim an AI dividend. Companies and many pundits and analysts have suggested that AI will not eliminate net jobs, that it will create new jobs for everyone that it displaces. And they cite every other major technology adoption as their proof. Equally, others hold out that whenever companies have found a way to cut jobs by leveraging technology, they have done so. The fact is, no one knows for sure what will happen. What we do know is that there's a steadily changing employment landscape in the tech sector. While opportunities in AI and engineering roles may expand, positions in middle management, non-technical, and service areas seem to be increasingly vulnerable. While one would hope that companies would invest in upskilling and helping with the adaptation to the growing emphasis on AI and automation within the industry, the reality might be that employees themselves may have to be the ones who take a serious look at their career planning. Whatever happens, this trend is not going to go away. And with companies trimming their workforce at a 3% level, it leaves many people vulnerable. With Microsoft ending support for Windows 10 on October 14th, 2025, it might be that companies and users are finally getting serious about upgrading. A recent study I read indicated that there is finally a movement towards Windows 11, and the estimates were that Windows 10 market share could have declined from about the 70% range to about the mid-50s range. There's still a large installed base of Windows 10, and the looming deadline could make some companies feel forced to upgrade at what might be the worst possible time. Very few manufacturers know what pricing will be like in the next few months, and with the on-again, off-again tariffs in the background, it just raises the uncertainty. As well, in anticipation of tariffs, many organizations appear to have pre-purchased their upgrades for at least the next several months, creating a demand that might have depleted stocks and may cause upward price pressure as scarcity looms. So what are the options? Well, there's the extended security update. Microsoft is offering ESUs for Windows 10 users at a fee of $30 for individuals and $61 for corporations for the first year. That grows to $120 the next year. It gets a little expensive, but at $60, it might provide critical security updates beyond the official support end date until things stabilize. And that $60 amount might be more attractive if scarcity and tariffs push prices way up. So the first thing to check, of course, is to make sure that you can't upgrade your own current hardware. While Microsoft suggests purchasing new hardware for Windows 11 compatibility, many existing Windows 10 machines might meet the minimum requirements. Worth checking. Alternatively, it might be time, especially for small and mid-sized businesses, to take a serious look at alternatives. With many applications running in software as a service mode, we might ask ourselves if other operating systems might not be something to look at. There's Chrome OS Flex that effectively turns older PCs into Chromebooks. And there are Linux variants like Linux Mint that offer robust support and can extend the usability of older hardware. This might not be for everyone, and in many cases where people have gone to open source in big purchasing, some of them have gone back. But especially where the requirements are just for word processing, email, and spreadsheets, and maybe some AI components, a Linux-driven PC might be something to look at. We've been using Google Docs for years now, and we found that we're using less and less of Microsoft 365, and for local use, we installed LibreOffice, OnlyOffice, and many of the open-source variants. So it wouldn't be a big deal for us to shift to Linux. Might be different for you. Of course, There's a lot that goes into decisions on hardware refreshes, but given the instability and the potential surprises in the market, and the fact that if AI continues to move at its current pace, it may radically change how we work. It might be reasonable to look at what alternatives you have, whether it's $60 per PC to buy another year, or investigate alternatives, or simply get in there and upgrade. But if you are committed to upgrade, now is the time to be talking to your preferred vendors to see what their plans are like for the coming year. In a recent meeting with CIOs that I attended, there's some serious changes happening in how vendors might be moving forward, sourcing, and even whether their inventories are going to stand up. At least one vendor is talking about importing directly into Canada to avoid tariffs. So if you haven't moved yet, it's worth having some discussions now. Better late than never. And that's our show. We'd like to hear what you think, and you can reach us at editorial@technewsday.ca or on LinkedIn or on YouTube. And you know what to do. I'm your host, Jim Love. Have a wonderful Wednesday.